You've heard that technical analysis can help signal buying opportunities. So, what might be the hesitation in using these techniques for your trading? Maybe you think you need to learn the math and statistics, and I know statistics was the bane of my existence in the second year of university. But today, we're going to simplify all of that. In this episode, chart trader and technician Patrick Karim will narrow it down to some of his go to chart setups that help him identify stock buying opportunities, ones that can help you integrate technical analysis into your own trading decisions. You're watching Inside Investing. Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Hiran Amin. Joining us is Patrick Karim, a seasoned chart trader from NorthstarBadCharts.com. Patrick has over 20 years of experience using technical analysis in his own trading. In addition to this, he also spends time training and mentoring other budding chart traders to help them improve their strategies and manage their risk as well. Patrick, welcome to the show, and great to have you with us.
Thanks, Hiran. It's my honor and pleasure there to be talking with you today. There, can't wait.
All right, well, we're going to get into all of the meat of our discussion just in a short bit. But before that, Patrick, a natural place I wanted to start, of course, is your platform, North Star and Bad Charts. That obviously begs some explanation. So tell us how that name came about, first of all, and what do you guys do with your online platform there?
Yes, sure. Well, look, Bad Charts, it's a misnomer. Hopefully people got that. I came up with that name back in 2011 or 12. I had a blog site. I was posting on Twitter, all that. They're super quiet. And yeah, I think it was a misnomer just to get attention. So get that bad charts out of the way. Oh, what bad charts? But then hopefully disprove that continuously by trying to provide the better and better charts over time, right? And so that's where it started. And then I had one of my friends there who lives in the UK, Kevin Wadsworth, and he's a meteorologist there for the UK government for 30 years. He's retired now doing charts, and he was called North Star Charts. He's always try to forecast the future. And together we created our website about 3 years ago, and we just combined both. So it's North Star, it's my friend Kevin, and myself, Bad Charts. So if ever people are his fans or my fans or both our fans, they could find our work on our website.
A lot of our viewers may be of the mindset, hey, to use technical analysis, I need to be a day trader or a swing trader. Do you have a different take on that, Patrick, or do you find that any investor should be sort of bringing TA into the conversation?
Yes, of course, because everything's defined by time frame. You're lucky, guys. You have price chart, and the top left corner of practically any trading platform, you'll have the 1 hour chart, 4 hour, 8 hour. And that's how TA works. Or even in life, everything's time to frame, right? Like I break my arm, have 6 weeks to recover. That event, that whole cycle from breaking to healing, it's 6 weeks of my life. So that's kind of short term, right? But let's say I have a cancer, God forbid, then that could take 6 months, a year out of my life. A small scrape, that cycle of healing, I'll be a few days. Same thing applies to trading. You should use TA no matter what the time frame. First, decide what your time frame is, your scope, how long you want to hold an instrument, and then you could start by looking at the time frame that fits. That's going to create a cycle that's going to last. The holding period should be around what you're looking for. So, look, zoom out, guys, for this longer term investor position type trading, and zoom in, day trader, swing trader, scalper. You zoom in, you have those tools, guys. So use the proper tools to fit the proper trading styles, and you'll be fine.
And interesting, you mentioned that whole zoom out and zoom in feature. It almost sounds like to me it's like the top down analysis versus bottom up when you're using fundamentals, where you're maybe looking and gauging a bit of the macro landscape first using technicals. So let me ask you this: do you incorporate fundamentals at all, or if you rely solely on the charts, you kind of ignore it?
The advantage of doing TA is you don't have to look at fundamentals. So even if I'm curious and sometimes I peek, the price to earnings, and I look at this fundamental stuff, or Apple releases a new iPhone, but goodness gracious, why would I throw away my edge and complicate my life? Like the TA, if you're going to focus and spend time on mastering TA, technical analysis, you have to spend time to master it. Why would I go and mess that up with with another field. It's like it's useless for me, because this is the main argument for using TA is you have a fundamental thesis, he has a fundamental thesis, she has a fundamental thesis, everybody on the planet has a fundamental thesis. But at the end of the day, they have to place their bets, and all the aggregate of all these bets at different times, at different moments, with different capital, all that stuff, guys. Think about it this way: all that decision making, I'll see in the chart, guys. I'll just see in the chart. If there's more buying pressure than selling pressure, the price will go up above an objective, unbiased moving average.
A lot of us find it difficult just to know where to start with, and especially configuring or setting the base for our chart setup. So can you take us through just the basic items that anyone who wants to do technical analysis should have on their charts?
Like a pure classical chart trader, he'll just look at classical TA patterns where he'll be able to identify trend lines. Like for a trend line to morph into existence, you need 3 actions: 1, 2, 3, 4, breakout, retest, and then off it goes. So essentially, you don't need more than that. But if you want an objective, like to get you going, just pop in the 3-year moving average and look where the price is in regards to that. Here, I'll just put the 3-year moving average. If price is trending above an inclining moving average, I could even here, check it out, guys. I'm just going to hide the price real fast for you guys. Remove drawings. Look, I'm in an uptrend. This is just a moving average, guys. Uptrend, uptrend, uptrend. For this to go up.
So you just remove the price chart there, and we're just looking at the moving average right now. Is that what we're seeing, Patrick? Okay.
So it's telling you that, look, objectively, there was a breakout the moment. So I don't even know. I know where the price is here. For this to be inclining, most of the time, the price has to be up here. If this is slowing down, that means there's some chop. The price is probably either going sideways, or it could be dipping below the moving average and adding sampling below the moving average and having it go down. And now you have, for this instrument, you actually have a breakdown in moving average. So I'm pretty sure right now that the price is hogging around here, and this is how you set the odds. If you want to be long this instrument above this inclining 3-year moving average, check mark, check. When it's going sideways, flattening out, or not going up as fast, not good. If it's declining, why are you in this, guys? Think about it. Why are you in this thing? If the moving average is declining, if you want to have higher probabilities of being in an uptrend, you want the moving average to go up. And and look at what happened. The price now is below.
Price is hugging it pretty closely. Yeah, exactly, to your moving average.
Yeah. It's not, now you're below a declining 3 moving average. It's not an area where you want to be. So you got to step away from this and just wait until the market tells you that. So it can be that simple. It just can.
One of the things you just showed, Patrick, was that what you look at is first, like when you have your chart setups, I know you have the candle, that's the candlestick that we're looking at. I know this is one of the things with charts, there's different styles you can choose. So is your preferred one the candlestick, or is the other ones that you kind of went through before you landed on this?
What matters most is the close. So here's the line chart. So it removes the noise. The line chart, guys, it's just the closes, right? It closed. So always look here. I'm on the monthly, and that was the monthly close. So whatever happened during the month, some crazy news during the month, the price went up, the price went down. But overall, the capital flows are carving an uptrend here. Now here, they're carving a downtrend. But what I like about the candles, guys, is I get some details on the intra-month price action. So here, the price went down. It opened here. It closed here. So on the line chart, I would just have a line now going all the way down here. But here, intra-month, the price went down even lower. But what happened before the month closed, buyers came in. And that's the wick. So the Japanese candles, there's a whole bunch of names, guys, you could look. There's a bearish engulfing, bullish engulfing, stars, dojis. Like there's a whole bunch of stuff. But essentially what's telling me is on the smaller time frames, there was enough buying pressure to bring the price back up. So these wicks here are often signs, not always, but they're signs of a possible reversal. So you get that additional information. So even if you're on the monthly time frame, I'm able to see what happened on the weekly, on the daily, by observing the behavior, the wicks,
Yeah. Does it tell you a little bit about like sentiment? Like there's a more bearish versus bullish sentiment based on the size? Does it give you a read on that?
Volume is often what I call a sentiment guide. People often think that you need a lot of volume. Often when we speak about an instrument, oh, crazy amount of volume. And people think that's a breakout volume or it's volume that's going to continue. But often when you hear about peak sentiment, it's often accompanied by peak volume. And it depends where the volume happens. With a wick like that, with that wick coming up, the month close, and look at that peak volume. That's often a sign of a strong bottom. Here, look, you have another example here. Look at the peak volume here at that wick down. And often you'll have peak volume at tops also. You'll have some heavy volume where the tops are, where everybody's trying to talk about that instrument. Oh, it's going to the moon. You'll have some volume here. Here, look, peak volume here at the bottom. Here, you'll have some volume here at the topping process. You'll have more volume than usual. So volume confirms, or in hindsight shows you, important turning points.
You like using the 12 and 36 month moving average, or is this completely different from what you have?
Yeah, that's what I like about going on the monthly chart. Using the 12 month is a yearly calendar cycle for companies. You know, the 1 year cycle. Then I like to use a multiple of that, so it could be the 36 month, those 3 years, just to give me a longer term vision of the trend, right? And when the shorter term starts overriding the longer term, that's like a golden cross. So I know the shorter term is trying to drag up the longer term, and the vice versa. But look, moving averages, guys, people are sticklers for it. Oh, I'm below the 200-day moving average. It's a short. Look, guys, every instrument moves at different speeds. You could start with a 50 and 200 or 12 month and 36 period. Like, it doesn't matter much. You could tune it. Most stocks, like regular SPX stocks, they fit good with that 12 month and that 36 month. But what you should do, actually, if you have time, is you go on your chart and then you could tune the moving average, lower it or raise it, so you get the most touches on it, but you don't breach it. So the more touches you have on any line, trend line, moving average, anything, it creates its validity. It's telling you the instrument is trading at that pace, and it's respecting that resistance or support as defined by that moving average.
And just to clarify, you're using monthly closes on yours, right? Like, these are monthly candles that you would have set up? Okay.
Yeah. And if I would zoom in on the weekly, I would still use the 12 and the 36 period. And if I zoom in on the daily, I'll still use the 12 and 36 period, just as a starting point. But guys, feel flexible to just increase or decrease those moving averages to do a best fit, right? TA is always about what fits the most logically, the best fit trend line, the best fit moving average, right?
With that being said, Patrick, can you show us, like, because you talked about some opportunities it does show you when you have these breakthroughs. So do you have an example of showing us what you're exactly looking at? Because are you taking action on a first breakthrough, or do you wait for certain confirmations to show up?
In TA, what we talked about was like the basics, above a moving average, but it's more than that. If you dig in, what you want to do to increase the odds of you having a successful trade doesn't mean it will be successful. It means to increase the odds, you need to do something what we call is an evidence cluster, or weighted the evidence. So if I'm above, right here, you see on this thing was downtrending back then, below a 12-month moving average. It broke out above a declining 12-month moving average here and this descending trend line. That's okay. That's some evidence, some bullish evidence, but I'm still below declining 3-year. I'm still below the Ichimoku cloud, which is a Japanese way of forwardly representing eventual support or resistance. There's no horizontal breakout line yet. There's just like, it's hard to see. Here's a wall. Here, I'm going to put that wide for you guys. A wall, guys, is what I call previous support turn resistance. Or a pivot line. People call it that. So here in an uptrend, support, now that support bounces, it's trying to discover that. It closes support, closes below, and that becomes resistance. Tests it from below, resistance, and it's never able to, and it's even sometimes it's like a zone. It's not able to overcome this resistance zone. Look, this is the important part of a trend line. The angle of a trend line is critical in assessing the probabilities of the move. So a severely declining trend line, the angle, I could jump up from here. Imagine I'm a little guy here running down. I'm jumping up. If ever I come in and fall to retest, I could fall much lower here, see, because the line's so much lower. If that line would be less steep, so that's what I call a wake-up line. But let's say here my line would be less steep here. If I jump out here, the chances of me falling much lower than that line of that trampoline are much lower, right? And a horizontal breakout line, this is what I call the final breakout line. It's flat. So if you close above a flat line, even if you do a retest should not hurt you emotionally too much. There won't be capital drainage, because the chances of you doing a severe retest 30-40% lower, they've practically disappeared. And the advantage of a horizontal breakout line is it guarantees you're in an uptrend, right? Because a horizontal line, guys, it needs previous pivot points. So that's a previous high here. So if I'm above a horizontal line, it guarantees that I'm doing a higher high. And that's half of the recipe of a new trend, uptrend, right? Higher highs, higher lows. What I got? I got an uptrend. So this is my evidence cluster, and it increases the odds. So once I've overcome the declining trend line, the slightly declining trend line, and the horizontal break trend line, look what happened to the price by then. It's above the 12-month, it's above the 3-year, and look at the nice move that we had in this instrument.
You are primarily first, no matter what signal comes through, you're looking at the overall trend to see if there's either that trend is kind of, I guess, becoming less steep in the direction it is in the case it was, or possibly turning before you're making any buying decisions. And then you also started touching on breakouts for me. So break those down for me. So horizontal breakouts is something that you look at. So what are we talking about here? Are we talking about patterns, or are you drawing SNR lines like support and resistance? So take us through that and maybe show us how you're using that to identify these signals.
All classical TA patterns, the powerful ones, guess what they have in common? Whether it's a rectangle box, a channel, or a head and shoulders bottom, or whatever, like they share the ones that have the higher success rate. Often they will share a horizontal breakout line, right? A flat base, a horizontal breakout line is the go-to for any type of pattern. Okay. So whatever happens under, seriously, I haven't seen like whatever, like here, maybe some people could say it's inverse head and shoulders. There's not much difference. Flat continuation patterns that have a flat breakout line, I will favor always more than a one. So sometimes you have these bullish descending wedges. Mm-hmm. So these while these resolve nicely, I would rather have a horizontal breakout line on my continuation pattern more than this, right? I rather this horizontal breakout line, because that confirms I have a higher high, while a bullish descending wedge that's breaking out, that's, you're still, remember, go back to this line here, guys, right? It's a descending trend line. So while it could go up, it could have halted here. It could have created an expanding wedge. That thing could have stalled a little longer. It has more work to do. So I'll always favor any pattern that has a horizontal line. I'll attach more probabilities to that play.
All right. That sounds good. We'll look out for those. So let me turn the tables and ask you a question now related to timeframes. So I know we talked about the moving average, but in terms of when you're observing the chart, is there certain timeframes that you like using? Like, do you like going to the daily, the weekly? Any specific ones that you'd like to share with us for some new would-be technicians?
Start the monthly, guys, because that will put less pressure on you as you're learning this. If you're looking on the daily and stuff's changing every day, your brain's going to overwhelm. So take a bird's eye view, go on the monthly. It'll give you time, because the next signals, confirmed breakouts or breakdowns, are only enacted on the close of the candle. So starting the monthly, it'll give you time to look through many different instruments. And then after that, at the first day of the month, come to your charts and just look at them. Oh, I have a confirmed breakout. Okay, well, then you could go to the next step, doing measured moves, classical TA measured moves. Is it above my moving averages? So start there, guys. Like, it's the easiest way. And the month, it's fast enough where you will get some good action, even if like you check once a month, a monthly defined breakout. Mm-hmm. You could have a nice 6-month run after that before the next consolidation. Hey, that's low hassle and better probabilities.
And it's like you said it so rightly. It's like it helps you cut out the noise. I mean, there's a lot of noise, and so when you use those higher time frames, that certainly helps with that. One of the things that you talked about just with looking for the different sort of indicators. So on the monthly, let's say you have a breakout happen, of course, but that's usually a go-to place. Then would it be fair to say that usually if there's a breakout happening on a monthly, you're probably going to see the same thing on like a lower time frame, like a weekly or daily, even possibly? Do you go there to look at confirmations for the monthly, or is it vice versa?
Look, ideally, you're at the end of the month, and it's June, it's the end of the quarter, and you have a quarterly breakout, you have a monthly breakout, and you have a weekly breakout all at the same time.
Mhm.
But most often, what you're going to see is if you have a monthly defined breakout, you will be stretched on the weekly. Because for you to get that monthly defined breakout, that means the weekly price action had to overheat, to get up. And that's why 80% of the time, within 1 to 3 months, a monthly defined breakout will have a retest of that breakout line, and which is super scary because you're retesting, because the smaller moving average time frames, they've been stressed. They're stretched from their mean, they're stretched from the moving average, and they're just going to want to naturally reset. So it's a pro and con game, right? You want to go on the monthly, you have to expect that the weekly is going to start resetting, the daily is going to start resetting, but you'll see that if you have a monthly defined breakout, you're going to be breaking out. Also, the weekly will have surpassed important resistance. But curiously enough, the higher the time frame, the lower the price required to break out, because
Mhm.
the higher time frame encompasses closes from the smaller time frames.
Right.
So the smaller time frame is able to have a line chart that's much higher than the bigger time frame. So the breakout level, let's say for instrument XXX, could be 2,000 on the daily chart. But if I zoom out to the monthly, I might need just a close above 1,950 to have a confirmed breakout. But
Right.
I always tell people it can't be marginal. If you have a breakout, it needs to be convincing. You need, let's say my breakout line's 2,000 and I close the month at 2,100. And people say, oh, no, I'm too far away. No, the market's telling you, and especially if there's no upper wick, right? There's no selling pressure during that month. Goodness, that's the market telling you something powerful, a paradigm shift. So you should be happy that it's a solid close. So of course you have to expect there's going to be a pullback, correction, whatever on the smaller time frames. But those are important signals. So if you have a monthly defined breakout that's much higher than the monthly defined breakout line, that means you're probably also going to have your daily and weekly charts. You'll be above their breakout lines. Goodness,
Yeah, just
guys.
confirming that for you as well. Exactly.
Yeah, yeah. You can't you can't deny that there. That's
Yes. Oh no, that's excellent. Well, Patrick, let's talk about one other thing, because we mentioned at the top of my opening that you're spoiled for choice when you first start with technical analysis. As you rightly said, at the end of the day, all these studies and everything that we have, they're just different sort of combinations or permutations of price put together into some sort of mathematical formula. So apart from just the overlays within the chart, is there any other tools you suggest or use as part of your analysis?
No, honestly, when I have time, I
Mhm.
love experimenting, because part of any field, it's good to do what like works. But primarily, what I showcased for your viewers, like
Mhm.
the work we just did on those instruments,
Yeah, your
that
moving averages, your patterns are kind of your go-to things.
yeah, it's
Yeah.
the basics. And the more you get apt at it, trust me, if you look at tens of thousands of hours of I don't know how many charts, you won't even need the moving average. You'll see it. That's what
Mhm.
classical TA is. There's no moving averages. They just know that a price action that creates a big base, that means the moving averages are flat. Instinctively, you realize it, because if price is doing a base and going sideways forever, what do you think is going to happen to the moving average? It's going to be going sideways. So the pros are people who have done classical TA. They don't need anything else. They don't, because they'll it's implicit what's happening to the indicators
Yeah.
by the price action, right?
And you know what? That's such a key thing that you said there, because I found over again with interviews, watching so many different technicians, it's simplified. They come and distill it down to the simple things, like you said, the patterns, pivot lines or SNR lines, the horizontal breakdowns. They don't get too involved, and that's, as someone who's starting out new, we can get lost in all these studies, feel like we need to incorporate this to get an edge in the market, but that's certainly far from the case. So good thing you pointed that out. There's another thing that can help, that can also derail us completely from technical analysis, and that's our emotions. One of the things that maybe I'll take to heart was, when I first got into technical analysis, I got to know myself a lot more better than I would have at any other time. And it has a way of really playing on your emotions and really getting to know how you're going to manage different things. So for you, Patrick, how do you keep that in check? It's a silent risk, emotions. It's not presented to you until you get into situations and you got to make quick decisions. So how do you How does this help you keep in check, or what is your mindset when you're using it to kind of drown out the noise, drown out the emotions there?
That's right. It's the hardest part. Humans are terrible traders because humans are terrible at these type of games, right? Like let's say even poker, you lose a big
Mm,
hand, you go on tilt. What the whole game plan, you throw it out the window, right? A boxer gets hit in the face and he starts brawling like Arturo Gatti instead of just staying behind the guard and jabbing. So what you got to do is really rely on whatever's objective, mechanical, not mechanical in the sense that, like, let's say you have a system, but set alerts, like don't look at the chart every day. Like you see those horizontal breakout lines, just send alert at that price level and go play golf, go take care of your family, play with your kids. Don't look at the chart every single moment. You will preserve that emotional capital. Because let's say I have a monthly defined breakout. I'm in the trade. As soon as you're in the trade, the emotional drainage, the counter, it starts. So if I'm on Twitter every day and I'm checking my bank account going up and down, guys, that's a recipe for disaster because the day goes down a little bit too much, or that day you were a little bit too tired, and it just happens. You look at it goes down, your portfolio goes down 5% on a day that you're tired. You got an argument with your wife. You're going to take a decision emotionally based. While if you were objective, you could have said, "No, look, I'm still above an inclining 12-month moving average. Why am I like the probabilities are still that this thing should keep going up or sideways or keep going up until it doesn't."
yeah.
So respect the charts, set alerts for breakouts, set alerts for breakdowns, right? You could set alerts, right click, set alert on an inclining 12-month moving average. And if the price closes below 12-month moving average, your broker or whatever is going to tell you, and you'll be able to assess there. So don't rely on the objective evidence. Set alerts, because it offloads. Like, do you try to remember? My girlfriend, she doesn't try to remember every single item she has to buy on the groceries. She has a list.
Yeah, she does.
She has
List
a
it good, like a
mechanic.
checklist. Yeah, trading plan
Yeah.
if you want, and you stay disciplined with it, right? That's what I'm hearing.
Yes, yes. And that's why if you don't have the game plan in front of you, then it's easy. And you know how we are, like our memory alters. Don't skew from the plan, right?
Yeah,
Professional teams, the quarterbacks, the coaches have beautiful plans. The players execute that. And over longer periods of time, those are the successful teams. Yes, you could get a Hail Mary once in a while, some audible play, but they're great. They look great. They're highlight reel stuff, but it's not the road to success there.
yeah, absolutely. We're gonna have to leave our conversation here. Thanks for sharing some of your top chart setups that you have for our traders. I'm certainly it's gonna help us with some of those buying signal opportunities that we have. And we've given our viewers hopefully a springboard to at least start their own trading journey with TA, or technical analysis in its full form. Any final thoughts you'd like to share with our viewers, Patrick?
Keep learning. It's never about 100%. It's about just assessing the probabilities the best you can with the evidence you have. And if ever the evidence changes, don't have your feet stuck in the mud, because as soon as you have a position, you become biased instinctively. Like I do it, like, oh, I own this instrument. I
Yeah,
want it to go up. Of course I want more money, but then that's a danger. And then minimize your losses, live.
mhm.
If your timing's off, cut your losses, reassess. There's nothing wrong with that. There's no pride or ego.
Yeah.
It's hard, but you got to practice that. The ego stays at the door, and you'll have a much better time there in this trading universe.
All right, excellent. Well, you all heard it here from Patrick himself. So please be sure to check out North Star Badge Charts as well. They've got some great content there. Thank you to our audience for joining us. Please also make sure to check out our full lineup of educational content. We have instructional videos, live masterclasses, and of course, more live inside investing shows, just like this one. So register now to continue your learning journey. Until then, see you all next time.
Have more questions? Check out the links to the right and in the description below.